Hello guys, welcome back to this video. So in this video we are going to cover what is the difference between ICT concepts, smart money concepts, referred to as SMC, and support and resistance trading. Then eventually we are going to answer the question which is more powerful than the other, if there is any. Now what I want you to know is that the concept of ICT, or the inner circle trading, or smart money concept, and support and resistance trading, each provide unique approaches to analyzing and trading in the financial markets. So I will start by looking at an overview of each trading style and a discussion of their differences, followed by offering insights into which into which one will be might be more powerful or suitable for beginners. Now this video it is going to cover the comparison is going to cover the strategies focus, that is the SMCs, ICT, and support and resistance focus, and then we are going to look at the key techniques or concepts in each, and then we look at the advantages and disadvantages, meanwhile providing examples. So let's proceed with the first example, which is the ICT concepts, or the inner circle trading concepts. Now this is also one of the most popular trading concepts outside here. If you just check ICT in YouTube, there's going to be tons of videos that are talking about ICT. Now basically ICT was developed by a guy called Michael J. Huddleston, also known as the inner circle trader himself. You can just Google the name and you're going to find the pictures of the person. Now what is the focus of ICT? ICT concepts emphasizes understanding the behavior of the institutional traders and the manipulation of price by smart money, or the big banks. We also call it BFIs. So the trading style seeks to identify where large financial institution places their orders and how they manipulate price to achieve the needed liquidity that fuels the market. Now there are key techniques, trading techniques that are very common in ICT trading, and that is fair value gap, order blocks, market structure shift, liquidity pools, or session liquidities, type-based trading, breaker blocks or breaking blocks, and then we have total sweep. Some call it total sweep. I like to call it total sweep. And then we have the Judas swing, and then manipulation, and then the commonly traded style of ICT, which is called the silver bullet. So most of these concepts are from the 2022 model. I watched it, and therefore I came up with all this when I was still trading ICT. Nowadays I combine it with the SMC. So basically you may ask, what is fair value gap? So this is an area in price where price moves rapidly in one direction and leaving behind an imbalance, especially rather I said where price moves rapidly in one direction, leaving behind imbalance, especially on the session sections like Asia, London, and New York. The order blocks simply means areas where institutional orders have been placed, indicating potential zones of support or something resistance, or where orders are stuck, in simple terms. Now they also look at market structure shifts, or MSSS. I'm going to explain it over here. So this is just an area where there is changes in the market sentiment that indicate a change in the direction or trend, something like that. I'm going to explain in detail using this. Liquidity pools. So liquidity pools are basically areas in the price where there is likely to be a concentration of stop loss orders and pending orders. So basically liquidities are based on are based in different regions, which I'm going to explain somewhere here. And then we have time-based trading, which emphasizes trading during specific sessions, e.g. London Open, New York Open. when institutional activity is high, especially on pair that moves in that particular section. So let's have an example. Let's look at this example. So we are assuming that the market is coming. How ICT look at the market and how they trade it. We are assuming that this market, it was a bearish trend. So the market moved, pulled back, caused a break of structure, moved, pulled back, caused a break of structure, and then let's say this is London session. This is session liquidity. So this is let's say this is Asia session. So you will start seeing accumulation of orders where there was series of range in that particular session, and then when another session opens, it takes one side of it using a very rapid movement, always V-shape. That rapid movement that take price that takes liquidity below any session, e.g. London and especially Asia, that particular rapid movement is what they refer as Judas swing, because it is a betrayal, something like that. And then below each session there is a manipulation point because of other people who are early buyers in this case and people who are early sellers in this case. So this is where, especially on the session open, that is where AMD circle begins, where we have accumulation, and then we have manipulation using the Judas swing, and then we have the distribution or displacement. So ICT traders will always look at the highs and the lows of each section to see where the liquidity are taking place. Now in most occasions this could be higher time frame, like 1 hour, and then they go to 15 minutes and start seeing this rapid movement, because this initiation, I call it initiation phase, is where I provide a lot of opportunities. Now to make it even juicier, some wait for this break here. So the last order block here that pushed price downward, that is what they'll refer to as a breaker block. So when it breaks, it should act as something like a support or a reflection point, whereby prices will come to it, tap into fair value gap with it inside. In that particular time frame, they call it the silver bullet time frame. Basically some between 30 minutes and 2 hours into the session, you can research about it. They always call it kill zones. So it will come and tap there, and then market will move expansively. So within this area there is breaker block which failed, a failed order block, and then there is a order block down here also, which is having adequate imbalance or fair value gap. So when price taps onto it, it moves. However, some people use OTE, optimal trade entries, and mostly they use it with fib levels, so 61.8 somewhere around here, or 50% or 79. If price pulls back deeper, they'll go with 79 etc, and then the stop losses will be down here, expecting the market to move forward. If you go to the chart, you're going to see this several times in Asia, in London Open and New York Open. You're going to see such kind of manipulation. So this is just a video to show you the difference. So go to the chart and look at this. Let's move to the next one, which is smart money concept first. So what about the smart money concept? Now before we move to smart money concept, I want you to take note of the following, that the ICT trading style has got its own advantages and disadvantages, as I've indicated here. So for example, one of the advantages is that it provides a deeper understanding of the market manipulation and institutional behaviors. Again, another advantage is it uses specific times and patterns to align with the BFI, and then it is very good, it offers very good RR. If somebody caught it down here and moved it here with the smaller tight stop losses, that means that is good RR, risk to reward. Another advantage is that it can offer you high probability trade setup by identifying where smart money are operating. Now what about the disadvantages? For beginners, it requires a lot of time and it is complex to learn, so you have to take a lot of time. Like I took a lot of time. This thing I started learning in ICT, I started learning in 2022, so it has taken me a lot of time. What about other disadvantages? So this thing heavily relies on identifying manipulations. especially for the sessions etc. So if you cannot identify manipulation, you are going to be manipulated. You will be the liquidity, which may not always be visible or easy to understand. So you have to take note, because this thing can also be discretionary. Somebody can say that this was the manipulation, this was the manipulation point, and then now this was the displacement, so they're expecting here to hold and then to push down. So it is all about subjection sometimes, but you need to follow what is called displacement, where prices are displacing. That is when you're going to know the exact point whereby you should be taking trades. Now for smart money concept, they share a lot of similarity with the other trading style, which is ICT. So basically smart money concepts aim to understand market structure and the interaction of supply and demand. Furthermore, it revolves around the idea that smart money or large financial institution leaves footprints in the market that can be tracked and used for trading decisions. Now, there are key techniques here that are related to smart money, and you will hear them a lot in smart money rather, and that is supply and demand. So which identify areas where the prices have previously reversed due to institutional buying or selling. Now there is also order flow. So there is order flow, order block, and order flow, order block. I forgot to write order block, and fair value gap. So but the most important one is I want you to note is order flow. So understanding the balance between buying and selling will help you identify order flow, and within the order flow there is always high probability order block and high probability fair value gap. Now it also relies on market structure, whereby you are recognizing trends, swing highs and swing lows, and a break of these structures. Another area is liquidity. So the market will always engineer its own liquidity while it is moving. So you need to identify this area where liquidity is built up, e.g. above highs or below swing lows. There are trend lines, the structural liquidities like IDM or inducement, and then you also identify support and resistant region where there is going to be a lot of manipulation, and then you also need to know trend line and other form of patterns that provide a lot of liquidity for smart money traders. So once you know this, you will know how to anticipate smart money actions and moves. Now let's look at this chart to demonstrate a snippet of how it works. So the market was moving downward, pulled back, caused a break of structure, that is the market structure and break of structure, and then it pulls back again, broke structure, leaving structural liquidity. So when that structural liquidity was taken, this is now true market structure. It tapped on the order flow where there is supply and demand, and immediately it plummeted. So there is a concept called SMT, where it's called smart money traps. So some people expect that this is a change of character or a market structure shift, but when they wait too long from this point, their stop losses are taken out because the overall market is bearish. So if this was 4 hours, some people will be looking to long here. Some work because if there's enough reaction, it will be pulled somewhere here and then push downwards. So we have a break of structure, then the market moves again, forms engineering liquidity, takes out liquidity, and then changes character again, causing break of structure. So when market pulls back to this zone again, which took liquidity, have a high probability order block, and then has a fair value gap below the order block, automatically it will try and rally downwards. So that is where most SMC traders try to trade. And then market causes break of structure again, it does complex pullback, which leaves equal lows, which are possibly IDM's zones. So when the market comes, takes them, taps on something here. So if the liquidity is so much, the market will just tap on 50% area, which in most occasions there is just fair value gap, or wicks of high and low of higher time frame candle. If you check here, you'll find wicks. So those wicks of 2 candles, there is always going to be some pullback in it, and then market shifts downward, causing a break structure, and then it taps on higher time frame POI, because like I said, there's smart money traps, and then there's point of interest, then this could be 4 hours, and then these areas of trade is where we go to 15 minutes and other time frames. So market taps on higher time frame POI could be order block, could be fair value gap, could be supply and demand zones. Basically in this case, this would be demand zone. So you see market trailing upwards, takes out early sellers, so this could be liquidity or could be just break of structure, and then it converts backwards, causing another, taking this inducement. Now if it is tapping high time frame POI and you're expecting reversal, we call it change of character here, but in most occasions some call it inducement, because the overall change of character should be somewhere here as I placed. Now, so people are expecting that the market is going to reverse from the change of character zones and pull downwards after taking this liquidity, so they always refer it to as SMT, but not all. Sometimes SMT is overruled, because it took all the orders from there before moving downwards, and then costing another complex pullback, tapped on the POI. I said it's order flow, fair value gap, and OB, high probability, because it took this low, this causing, changing this to be liquidity point. So there are no more orders down here, so it taps on this POI, causes internal change of character, I choke, and then causes another break of structure. So some people call this just liquidation, and then the next one would be internal change of character. So this is what seals the deal that this market is about to pull upward. So it depends. If you watch different videos, you are going to learn that. If you want to know exactly how to apply them, you can check my Telegram group, where I show all this for free, and I show all my trades. As you can see, this one was a gold trade of yesterday. We took it over there and it is still moving, and then we have the initial posting of where I said, so if this dealing range high, so if this high goes, I buy. If this high should be low goes, I sell. So eventually this high, if this low goes, I sell. Eventually it went and we sold. So there are other trades we took, like this USD card. There is this sales that we projected somewhere here, sales confirmed. So sales was confirmed here, but I said I gave it out here just before you entry order block, because the market had already changed character here with downward displacement, leaving fair value gap. So this was the ideal order block to take trades from. So could be from here, but I just took the all of the order flow, tapped on it, and as you can see, the market moved rapidly. There's this one that we took that came to break even and immediately changed the character, and offered sales in return. So it offered sales in return. This one, we say that if it changes here, and then it's going to sell. So if you want to learn how to trade using order flow, you can just join this Telegram. It's for free. I'm not charging anything. So let's go back to the break of structures. So you can see the here market pullback, break structure, took another IDM, tapped on order flow, fair value gap, etc, or basically demand zone, and then moved upward. There was another SMT. People are expecting to short here because IDM, this IDM, some people call it change of character. So it then did not drop, took the stop losses and moved. Now another trading style is support and resistance trading, and now this is where I started trading. So support and resistance. Now before we go to support and resistance, let me just touch on advantages and disadvantages of this. I keep forgetting, and that is why I wrote it over here so that I don't forget. Now so SMC on the advantages, SMC focuses on understanding market structure and the broader flow of the institutional money, or the BFI's movement. Now it uses common tools like the trend line, zones, etc, making it somewhat easier to understand. And then it offers good risk to reward management, not management rather, but good risk to reward ratio. And then it offers insight into the balance of supply and demand. Now on the disadvantages, it still requires a deeper understanding of price action. It is not beginner friendly because all these concepts I've explained are covered in this channel. So check this channel and you're going to find all these concepts covered in detail, whether be order block, fair value gap, supply and demand zone, order flow, institutional IDMs, smart money traps, etc. All of them are covered. Ideal, POI, they are all covered. So you need a lot of time to understand them. And then let's focus on specific time-based strategies compared to ICT. This thing you can trade from higher time frame perspective without really narrowing down to sessions, because most people trade this in 4 hours and it still work well. So you don't pay a lot of attention to the session. Now on the support and resistance, we'll go quickly. You can see the way it is messy. If I use smart money, I can easily congest this thing to pull back, push, pull back, push, pull back. Then we have a push here, then we have some sort of change of character here, and then the market moved upward again in that order. But for the support and resistance, they use trend lines to know where the market is moving, and then they want reaction zones. So the market moved downward, came here, consolidated. That means it matched a support from other levels here, so it pushed upward, then came. So if you took this move, you got some profit, and then it came, broke throughout, and then this support now turned to resistance. So it resists now the prices again. There is also some other patterns that are also looked into, like shoulders, head and shoulder. Like this is now first shoulder, this is the head, this is the shoulder, and this is the shoulder. Then we have a breakout, so it can even be inverse, by the way. Like this is the shoulder, this is the head, this is the shoulder. So you're expecting the price to move upward. So to me, this thing is really complicated to know, because a lot of it is subjective. Now market moves down, consolidates a little bit, or meets a support from this other area, from previous price actions, and then tries to range for a while before again holding and moving upwards. Now there's also another pattern being formed here. You can see so many head and shoulder, but like this is head, this is shoulder, this is shoulder, this is head, this is shoulder, this is shoulder, this is head, this is another shoulder. So it is really subjective, but they try and use it there. They can also use wages, wages like this, to know where the price is moving, like on a downward movement. So personally, I don't trade support and resistance because of how subjective it is. I can see a lot of buys in where people are seeing sells, and then eventually you're chopped out. So that is why I don't use support and resistance. Then there's another breakout here, so we are expecting this to resist price and bring it down. There's another support somewhere here. I wrote it resistance, should be support, because market moved downward, met support, and then move upward, met resistance. So basically, support and resistance over one of the most used technical trading technique. It involves it revolves around identifying key horizontal levels on chart, these horizontal levels where price has historically reacted, either reversing direction or stalling, as you can see I've demonstrated here. And then so the key techniques applied here are support levels where buying pressure has historically overcome selling pressure, preventing the price from falling further, like in this case here. And then there's also resistance levels, price levels, where selling pressure has historically overcome buying pressure and preventing price from rising further, like this here. So if it breaks, support turns to resistance, and then you're expecting the price to move. Then they also use trend lines to know how the price is moving. So diagonal support and resistance lines, like the market tapped here, moved down, tapped here, moved down, tapped here, moved upward. So there are so many support and resistance trend lines. You can just choose whichever you want. Then chart patterns like double tops or head and shoulders, and then double bottoms, head and shoulders, that are formed by support and resistance level. So there are so many here. You can always research about them. Now, what about the advantages of this trading style? It is simple to understand and widely used by traders. So you can comfortably draw so many, like they always say that try and cover most of the area in your box. So anybody can draw these boxes where there is consolidation. It's only whatever you do with them that is going to affect how you trade, but anybody can draw this area of consolidation. That is why it is easy. So if you just draw this area of consolidation, and when price comes to it, just try and buy from there or sell from there, depending on how you want it. So it can also be versatile and combined with other trading strategies. Like I always combine these things with SMC to trade. If you want to check that, check my Telegram. And then we have other disadvantages of this trading style. So support and resistance level can sometimes be subjective and vary between traders. So I can be seeing sell here, somebody is seeing buy. I can be seeing sell, somebody seeing buy. Somebody seeing buy, I'm seeing sell. I don't like such kind of trades because of how subjective it is. Then it provide vague entries. Now, where do I need to know where to enter here? So it is the vague entries that leads to even vague exit. Where do I enter here and where do I leave here? So in most occasions, you want to try and cover the whole zone, and this could always result in a bigger stop loss and a smaller take profit. So I don't like that kind of trading. And then market can break through the levels, leading to false signals, also called false breakout. Like somebody, if this was the case, break this, somebody may expect that this is false breakout to keep taking this high, and then eventually it plummets. But if I was using SMC, I would see that this is a drop, or even supply and demand. I would see that this is a drop, a base, and then we have manipulation, and then a drop again, or a base, a rally, and then it drops. Then we have a base again, a rally, and then a base, and then drop. So at least there is some logic to it. So another disadvantage of this kind of trading style is that does not provide insight into the institutional order flow or market manipulation. So if you are somebody who is inquisitive and want to understand how the market is moving, definitely you will have to suffer here, because it does not explain what is happening here, other than it is reacting to some POC, point of control. So especially on, if it is on how do we call it them? We call them full figure numbers. We call them key levels. So you check here, you realize that whole numbers, psychological levels are numbers like 150. So anything that ends with 0 and 5, most likely they are psychological numbers, but mostly 0, 0 and 0. That is where people buy, because if you go to markets to buy something, you always talk about 100, 200, not 1 or 2, 1 or 3. So that is why these reaction points always try to find such area, and such area in smart money we call it a point of control. If you want to learn point of control, check in this channel. You are going to learn how to operate with the point of control. So let me help you answer one of these questions, which is which trading style is more powerful for beginners or generally. So it depends on these 3 parameters, or 4 parameters rather. It depends with what you want based on these 4 parameters. The first one is which trading style is simple, or the simplicity and the learning curve of these particular 3 strategies. So if you want to learn simple and start trading today or tomorrow or this week, support and resistance is easy to learn, but you will not understand based on the disadvantages. So it is easy to understand. And then so support and resistance, this is the simplest and the most intuitive concept of beginners. It provides a straightforward approach to understanding how price react to certain levels and offer trading opportunity in those particular zones. So it's always a good starting point for anybody who is a beginner to understand the basic price action. So what about the depth of understanding the market behavior? If you want to understand the market behavior and how the market moves well, then you have to learn ICT and SMC, or one of them, because they are almost the same. So you just need to learn one of them and you're good to go. So they both provide a profound insight into how institutional traders operate. They teach traders to think about the market in terms of liquidity, order flow, and let's say market manipulation, while more powerful in understanding the market of the deeper levels, at the deeper levels. So you will need to have a steeper learning curve, because it's going to take you time to understand all these SMC concepts that I've just explained. Now, what about adaptable trading strategy? Support and resistance is very adaptable because of how subjective it is. So it can be used across various market and time frames with minimal let's say adaptation. So ICT and SMC, they all need adaptation based on market condition and specific strategy, but this is less adaptable. That is what I mean. So you just need to copy paste the same concept from one point to the other. So on this other SMC and ICT, you may be required to adapt a lot. That is why we have something called smart money concept and trap zones, or smart money traps. Now, what about on risk management? If you're somebody who like good RR, then you have to use ICT or SMC. So SMC, all these approaches are good at providing risk management or something, but ICT and SMC offer more precise entry and exit point due to their focus on the institutional behavior, potentially leading to better risk to reward ratio. That is why it is winning. So those ones are the only three parameters that you the four parameters that you have to choose. So choose whichever you want to use the best, and then go with it, because for any beginner, support and resistance is usually the best starting point due to its simplicity and ease of understanding. So once you are comfortable with this concept, you can start exploring smart money concept, and then you can now go deeper into ICT concepts to gain a more sophisticated understanding of market behavior and the institutional influence. Now, each of these approaches has got their own strength, which I've discussed. So based on them, pick whichever you like.